Revenue grew 16%, profit grew 29%. Why is there a gap, and where exactly did it come from? That spread is the entire story of this quarter, and it doesn't answer itself. Between first quarter 2025 and fourth quarter 2025, 2 full quarters, revenue barely moved. Then, in a single quarter, it adds $2.7 billion. Nothing in the prior quarter signaled this was coming. So the question isn't how much it grew. The question is, what inside this business can add $2.7 billion in 90 days and leave no trace of it the quarter before? One line moved from 20.6% to 32.7% of total revenue in a single quarter. That's not drift. That's a reweighting. And when you isolate the dollar amount, trading added more than $3 billion in absolute terms over that same period. That number alone is larger than the entire revenue jump. Now look at what stayed flat. Asset management, steady at roughly a third of revenue across all 3 periods. 2 lines, completely different behavior. One moved the entire result. If trading hadn't expanded from 20% to 33%, what does this revenue chart actually look like? 3 businesses, 3 completely different stories this quarter. Institutional securities added $2.8 billion sequentially, from $7.9 billion to $10.7 billion. Wealth management moved less than $100 million quarter over quarter, though over 12 months, it quietly built from $7.3 billion to $8.5 billion, 16%, almost entirely through fees that compound with every dollar clients keep inside the bank. Investment management went the other direction, down 4% year over year. And the reason sits in a single line. Performance fees collapsed from $151 million to $39 million across 3 consecutive quarters. 3 segments, one accelerating hard, one building slowly, one shrinking where it matters. If institutional securities had simply held flat at $7.9 billion, does total revenue grow at all this quarter? Costs went up $1.3 billion. Revenue went up $2.7 billion. That gap is the only reason efficiency improved. This wasn't a leaner operation. Compensation grew. Non-compensation expenses grew. The bank even absorbed $178 million in severance from a March workforce reduction, already inside these numbers. The efficiency ratio improved because the denominator grew faster than the numerator, which creates a very specific dependency. If revenue growth had been $1 billion instead of $2.7 billion, at what efficiency ratio does this bank actually operate? Pre-tax margin expanded almost 3 percentage points year over year. But connect it back to what moved. Trading carries higher margins than most other revenue lines. When it goes from 20% to 33% of the mix, it pulls the blended margin up with it. This isn't operational improvement alone, it's compositional. The business didn't necessarily get structurally more profitable. The revenue that came in this quarter happened to be the kind that keeps more per dollar. When trading normalizes back toward 20% of revenue, how much of this margin expansion travels with it? Quarterly ROE moves from 4.35% to 5.39% in one quarter. Net income increased by over $1.1 billion to make that happen. But notice what the number still reflects. The bank is generating that return on top of an equity base that keeps growing. Book value per share went from $64 to $66 in a single quarter. More profit, yes, but also more capital underneath it. ROTCE tells a cleaner version, 6.93% this quarter against a tangible base of roughly $81 billion. The bank earned more. The capital base also expanded. How much higher does net income need to go for these quarterly return figures to move into a structurally different range? Last quarter, $18 million in provisions. This quarter, $98 million. 5 times more in 90 days. The source is almost entirely inside institutional securities, commercial real estate, the same exposure that appeared last quarter and the quarter before that. Now look at the other side. Wealth management provisioned $6 million against a $186 billion loan book. That's 0.003%. A portfolio growing 15% year over year with almost no credit stress showing up. 2 loan books inside the same bank, one nearly clean, one with a line that keeps reappearing. Is the CRE provision finding its floor? Or is $92 million the number that keeps growing quietly while trading captures all the attention? CET1 is 15.1%. The regulatory minimum is 4.5%. The buffer is real and substantial. But 3 quarters in a row, the leverage ratios move in one direction. SLR 5.6, 5.4, 5.0. Tier 1 leverage 6.9, 6.7, 6.1. Both declining consistently. Not because capital is shrinking, but because the balance sheet is expanding faster than capital accumulates. More loans, more trading positions, more exposure. And simultaneously, the bank is accelerating buybacks. The capital position is strong. The trend inside it is worth tracking. At what point does the pace of balance sheet expansion, combined with accelerating distributions, require a recalibration of how much capital is actually available? 3 quarters. 3 consecutive increases in buybacks. $1 billion, $1.5 billion, $1.75 billion. Combined with dividends, the bank returned $3.3 billion this quarter on a net income of $5.6 billion. Nearly 60 cents of every dollar earned went back out the door. In fourth quarter 2025, that number hit 70%. The bank returned more than it kept, and the share count reflects it, down from 1.607 billion to 1.580 billion in 12 months. That reduction is part of what's driving EPS higher. Now hold 2 things at the same time. Leverage ratios compressing for 3 quarters and buybacks accelerating for 3 quarters. Both are true simultaneously. What does the pace of capital return look like if the environment that generated this earnings level changes? At $188.84, the market is paying $3.66 for every dollar of tangible book value. PB at 2.85 times. PE at 55 times on a single quarter's earnings. Now connect the price to what generated it. A quarter where trading went from 20% to 33% of revenue, where one segment drove nearly all the growth, where margins expanded because of mix, not structure. The price embeds an assumption that the bank continues delivering at or above this level, which is a reasonable assumption if this quarter reflects a new normal, and a very different conversation if it reflects a window. At 3.66 times tangible book, how much of what happened this quarter needs to repeat and for how long for this valuation to hold? Line them up. Trading share increases. IS revenue surges. Margins expand. Efficiency improves. Returns rise. 5 movements. 1 source. Now look at what moved in the opposite direction while all of that was happening. CRE provision doubled. Leverage ratios kept compressing. Performance fees in investment management hit their lowest point in 3 quarters. The bank had a record quarter. That's the fact. And inside that record quarter, one segment drove the result, one credit exposure kept growing, one business kept shrinking where it matters, and the capital buffer kept tightening. 2 scenarios sit inside this data. In the first, trading stays elevated. WM continues its quiet compounding, CRE stabilizes, and the leverage compression reflects deliberate balance sheet expansion rather than constraint. In the second, trading normalizes. The revenue mix shifts back. CRE provisions continue building, and the efficiency and margin gains that looked structural turn out to have been compositional. The numbers don't tell you which one is coming. What they do tell you is exactly which engine to watch, and what happens to everything else if it slows down.